Professor Nam-Yong Lee's long commentary, "The US Digital Dollar Genius Act Will Change Korea's Money and Freedom," an overview of the Genius Act. The Genius Act, Guiding and Establishing National Innovation for US Stablecoins Act, is the first and very decisive federal law by which the United States brings a new kind of digital dollar, the stablecoin, squarely into the formal regulatory system. A stablecoin is, in simple terms, a digital token that promises you can exchange one coin for $1 at any time, and until now it has been loosely issued by private companies and projects in many different ways. The Genius Act classifies these stablecoins as a new kind of money called regulated digital cash, which is neither bank deposits, nor securities like stocks, nor commodities like crude oil. This means that, within the United States, stablecoins used for payments and remittances will now have an independent legal status and will no longer be treated as just another coin, but as part of a state-designed digital monetary infrastructure. The core of this law is very simple yet powerful. It blocks just anyone from issuing stablecoins and erects a narrow gate so that only licensed issuers can create coins. Issuers must hold safe assets equal to 100% of the amount they issue, be ready at all times to redeem one coin for $1, and regularly disclose the size and composition of their reserves to the public. On the surface, it looks like private companies are minting coins, but in reality, money can move only inside the framework set by the US government. For citizens and investors, the rules become clearer, which is an advantage, but at the same time the space for free experimentation and innovation shrinks, which is a trade-off. From the perspective of relational philosophy, the Genius Act is not a narrow technical law that simply regulates one coin. It is a systemic blueprint that reshapes the power relationships among money, banks, US Treasury bonds, big tech, and foreign regulators. It redraws in legal form who creates the digital dollar, who supervises it, and who captures the economic benefits. Through this act, the US government seeks to pull previously unregulated crypto capital that relied on stablecoins back into the orbit of US treasuries, banks, and the anti-money laundering regime. For countries like Korea, this becomes a starting point for strategic decisions about how to position the relationships between the dollar and the won, banks and coins, and regulation and freedom. Who is allowed to issue stablecoins? The Genius Act pushes stablecoin issuers into a narrow gate called a Permitted Payment Stablecoin Issuer, PPSI. There are three broad types of entities that can pass through this gate. The first is subsidiaries of banks and credit unions whose deposits are covered by deposit insurance. The second is federally licensed non-bank issuers newly authorized by the U.S. Office of the Comptroller of the Currency, OCC. The third is state-licensed issuers that satisfy certain conditions. All other companies and projects are barred from issuing payment stablecoins and are effectively pushed out of the market. This structure acts as a filter that allows only a very small fraction of the world's many stablecoins to survive, while the rest are naturally wound down. These licensed issuers are subject to very strict common requirements. They must hold safe assets such as US dollar cash and short-term US treasuries in a 1-to-1 ratio against the total amount of coins they have issued, and they must disclose in detail every month what assets back their reserves. They must also undergo regular external audits to verify that those reserves actually exist and have not been inflated through accounting tricks. In times of stress, they are required by supervisors to freeze specific addresses, temporarily limit redemptions, or if necessary cancel outstanding coins. From the issuer's point of view, freedom is reduced and costs rise, but in exchange they gain the powerful brand value of being a fully regulated, system-trusted institution. In relational philosophy terms, trust in money does not come from numbers but from relationships. The Genius Act tightens the relationship among issuers, reserves and supervisors, and designs a structure in which users trust and use stablecoins based on that relationship network. In the past, the core of trust lay in the issuer's marketing narratives and investors' expectations. Going forward, it will lie in reserve disclosures, legal liability, and the relationship with regulatory bodies. What citizens need to understand is that the critical question is no longer only the coin's brand name, but which law and which regulator stand behind that coin, the structure of bank and non-bank issuers. Let us first look at bank subsidiary issuers. These entities are already under the umbrella of deposit insurance provided by the Federal Deposit Insurance Corporation, FDIC, and bank regulation, so the stablecoin business is added on top of an existing regulatory framework. Their reserves consist of central bank accounts, US treasuries, and bank deposits, and their risk management and internal control standards follow those of the parent bank. In this structure, a single stablecoin functions like a bank's digital money market fund, while at the same time serving as a payment instrument moving 24 hours a day on the blockchain. Users who spend the coin are effectively relying on the bank's creditworthiness and regulatory supervision at the same time. Federally licensed non-bank issuers are a new form of fintech financial company that are not banks, but are subject to bank-level prudential regulation. They can issue stable coins and operate digital wallets, payment networks, and on-chain payment services together. However, when investing the reserves that look very similar to customer deposits, they must comply with strict investment limits, and they must maintain minimum capital adequacy and liquidity ratios set by regulators. In crises, they carry the obligation to adjust redemption speed or immediately block transactions involving specific countries or addresses according to supervisory instructions. In short, they are redefined not as freewheeling startups but as regulated financial infrastructure providers. State-licensed issuers are authorized by state financial authorities such as those in New York and may operate under state regulation alone up to a certain issuance scale. But even then, their state regulatory framework must be evaluated as substantially equivalent to the federal standard, and they must participate in international supervisory cooperation through ties with the US Treasury. For small regional issuers, this can be an opportunity, but for states or countries with weak regulatory capacity, it becomes an inherent competitive disadvantage. From Korea's perspective, this structure provides a useful reference for who should be allowed to issue won-denominated and dollar-denominated stablecoins in the future. Will we restrict issuance to subsidiaries of commercial banks, or open a limited path to securities firms, card companies, and fintechs as well? How stringent will we make reserve and disclosure obligations? Depending on where we draw these lines, the market structure can change dramatically. If we design it poorly, we may entrench a monopoly or oligopoly of a few large financial institutions and weaken innovation and competition, which must be carefully considered. The red card shown to big tech and foreign issuers. Another core feature of the GENIUS Act is the mechanism that blocks big tech. Publicly listed big tech companies whose primary business is not finance are, in principle, prohibited from issuing payment stablecoins. To issue them as an exception, they would need unanimous approval from a review committee that includes the Secretary of the Treasury, the Federal Reserve Board, FRB Chair, and the FDIC Chair. This is clearly intended to prevent a repeat of Facebook's Libra project, where a giant platform tried to create a private dollar and potentially destabilize monetary policy and financial stability. Big tech companies may become partners in payment infrastructure, but the law erects a wall against them becoming independent currency issuers. The hurdle is equally high for foreign issuers. Any foreign issuer that wants to sell coins to US persons or list them on US exchanges must show that its home country regulates stablecoins at least as strictly as the GENIUS Act does. It must also hold reserves at US financial institutions and be able technically to respond to US court orders to freeze or seize funds and to comply with anti-money laundering directives. The demand for technical capability means that the token contract and system design must contain some form of backdoor or management function that can reflect regulatory orders. In substance, unless a foreign country accepts US-style regulation, its stablecoins will find it very difficult to gain formal entry into the global dollar stablecoin network. Finally, all licensed issuers fall under the US Bank Secrecy Act, BSA. They must implement full customer due diligence and know your customer, KYC, file suspicious activity reports, filter against sanctions lists, maintain detailed records, and have the ability to freeze addresses and burn tokens. In this process, an issuer ceases to be merely a tech company and becomes a highly regulated compliance organization which must greatly expand its legal, compliance, and risk control staffing. This is how a form of money that is as fast and convenient as digital cash acquires a second face as a permanently traceable, controllable instrument. Citizens must clearly recognize both sides at once, the benefit of shutting out criminal funds and the risk of excessive surveillance and control. How the map of the stablecoin market will change. The first to disappear will be algorithmic stablecoins and fractional reserve stablecoins, models that maintain their price algorithmically without full reserves, or that hold only partial backing while investing the rest in risk assets, will effectively fail to qualify as payment stablecoins under the GENIUS Act within the United States. This reflects a determination not to see another collapse like Terra. In the process, many experimental crypto projects will naturally be driven out of the US payment market, and only a small group with the capital and organizational capacity to handle regulation will survive. On the other hand, the winners will be compliant tokens. Dollar-backed coins issued by US banks and those issued by highly trusted entities with fully collateralized reserves will see broader use in payments, cross-border remittances, and as collateral assets in DeFi, decentralized finance. Major exchanges and institutional investors are likely to restructure their portfolios around such coins over the long run. The ecosystem may move from a landscape of hundreds of stablecoins to one dominated by a small number of giants that effectively become the core operators of the global digital dollar infrastructure. Smaller projects and issuers from emerging markets will be at a structural disadvantage in competing with these giants. Another important change is that all reserves are tied to US dollars and US treasuries. As the stablecoin sector grows, structural demand for both US treasuries and dollars naturally increases, allowing the United States to finance itself at lower interest rates. At the same time, if digital dollars become easy to use everywhere, the national currencies of emerging markets can be pushed to the back. The Korean won is no exception. If households reduce their won deposits and hold more dollar stablecoins, the effectiveness of the Bank of Korea's monetary policy will decline, and the won exchange rate can become more volatile. Conversely, a new type of system risk also grows. In a crisis, if people rush en masse to convert their stablecoins back into cash dollars, issuers will have to dump large volumes of short-term treasuries, which can trigger spikes in treasury yields and turbulence across financial markets. In the past, bank runs were the main fear. Going forward, a stablecoin run surrounding digital dollar reserves may become the new threat. The GENIUS Act straps on a new kind of financial safety belt, but at the same time bolts on a new digital treasury money market engine. We must soberly examine what shocks this engine could transmit to household economies and financial markets in emerging countries when it runs at high speed. What happens to Bitcoin? Strictly speaking, the text of the GENIUS Act targets only payment stablecoins. Bitcoin is not a direct object of this law, yet when the entire ecosystem is reshaped, Bitcoin's role is inevitably adjusted. Once stablecoins secure their place as regulated digital cash, Bitcoin is likely to be seen less as a payment instrument and more as digital gold, a store of value, and a leveraged speculative asset. In other words, regulated stablecoins may increasingly handle everyday payments, while Bitcoin specializes in long-term holding and price speculation. At the same time, as regulated stablecoins channel institutional capital into the crypto markets, access to Bitcoin can actually improve. Institutional investors, able to settle and hedge quickly in stablecoins, can more easily trade Bitcoin futures and spot positions, deepening market liquidity and market depth. Exchange-traded funds, ETFs, and mutual funds that provide indirect exposure to Bitcoin may proliferate, and in that environment, stablecoins become the core infrastructure for settlement and collateral management. Bitcoin thus becomes positioned as a high-risk, high-return asset floating on top of a regulated digital dollar layer. On the other hand, Bitcoin's political meaning and censorship resistance may become more prominent. If stablecoins are digital dollars that can be frozen or seized at any time, some users will seek a value store beyond the reach of state control. One of the main candidates is Bitcoin. For citizens in authoritarian regimes, in sanctioned countries, or under severe political repression, Bitcoin can look less like a speculative tool and more like a survival tool. In such a world, international politics and regulatory debates around Bitcoin will grow more complex, and Korea will also be pressed to choose a stance. To understand these changes properly, we must see Bitcoin not just as a price chart, but as part of a larger relationship web involving freedom and control, sovereignty and surveillance, a new landscape for Ethereum and DeFi. In the world of Ethereum and DeFi, decentralized finance, stablecoins already function as the beating heart. Lending, deposit-like products, derivatives, automated market makers, and countless other DeFi services use stablecoins as their unit of account and settlement asset. After the GENIUS Act takes effect, DeFi projects and centralized exchanges, CFI, centralized finance, that serve US customers will have no choice but to prioritize GENIUS-compliant stablecoins. A clear hierarchy will emerge between regulated and non-compliant tokens. If a service wishes to keep its front end open to US users, the stablecoins it uses in the background will have to satisfy regulatory requirements. DeFi can then split into two broad paths. One path is to adopt compliant stablecoins and implement KYC, Know Your Customer, AML, anti-money laundering, nationality checks, geographic restrictions, and front-end blocking. Projects that choose this route will increasingly resemble traditional financial institutions in structure and process. The other path is to remain outside regulation, serving offshore users and preserving anonymity. Projects on this path may gradually fade into the shadows for citizens of advanced economies such as the United States, Europe, and Korea as access channels close. Ethereum itself will remain an open public blockchain infrastructure. However, the financial services built on top of it are likely to become more and more similar to traditional regulated finance. On-chain money markets, lending platforms, and derivative protocols will need to speak the language of regulation, including reserve proof, risk disclosure, and audit reporting in order to survive. Korean projects and exchanges will likewise need to design architectures that meet GENIUS-level standards for reserves, disclosure, and AML, while aligning with domestic laws and international regulations. Otherwise, they may enjoy brief popularity only to disappear in a single blow when the regulatory environment changes. Points of conflict with Korea's Capital Markets Act. Korea's current legal framework divides responsibilities between the Virtual Asset User Protection Act and the Capital Markets Act. Instruments with clear investment features, such as stocks, bonds, and funds, fall under the Capital Markets Act, while most other coins are governed by the User Protection Law. Payment stablecoins, however, have an ambiguous character. They are used like money, but if they pay interest, they can look like investment products, and when used as collateral, they form part of derivative structures. Thus, the same asset can have multiple faces depending on which law is applied. The GENIUS Act directly addresses this confusion. It deliberately excludes payment stablecoins from the definitions of securities, commodities, and deposits, and bundles them instead under a distinct set of requirements around reserves, disclosure, and AML. Korea's Capital Markets Act currently has no such independent definition for payment-type stablecoins. As a result, the same coin may be treated as digital cash in the United States, but as an investment product or a generic virtual asset in Korea. Investors and companies can then be uncertain which law actually applies, and grey areas of regulatory arbitrage emerge. In the end, such ambiguity tends to disadvantage ordinary retail investors. Another point of conflict lies in monetary policy and foreign exchange management. If dollar stablecoins circulate freely in Korea without clear rules, what appears outwardly as a virtual asset market may in substance function like foreign currency deposit markets. If households reduce their won deposits and hold large amounts of dollar stablecoins, the Bank of Korea's monetary policy loses traction and the won exchange rate becomes more unstable. As the boundaries between the Capital Markets Act, the Foreign Exchange Transactions Act, the Banking Act, and the Electronic Financial Transactions Act blur, a new channel opens through which won deposits can flee into digital dollars during crises. Finally, there can also be friction between Korea's emerging security token offering, STO regime, and stablecoin regulation. If policy promotes STOS while regulating payment stablecoins separately and inconsistently, markets will construct increasingly complex structures in the gaps between those regimes. Legislation will always be one step behind, and the resulting costs and risks will ultimately be borne by retail investors and households. For this reason, Korea must begin now to prepare a GENIUS-level framework for clear asset classification and supervisory principles, a Korean K-stablecoin model, and reform of the Capital Markets Act. The first thing Korea needs is a separate legal definition for payment-type stablecoins, whether under the Capital Markets Act or a new Digital Asset Basic Act. We must carve out a distinct category for tokens, both won and foreign currency linked, that are used for payments and remittances. This category should share a common set of minimum principles: 100% reserves, conservative reserve asset composition, centered on safe assets, monthly public disclosure, regular external audits, and priority rights of stablecoin holders in the event of issuer insolvency. Only then will the line between investment-type tokens and payment-type tokens become clear, and citizens will be able to understand which assets resemble deposits and which are high-risk investments. Second, we must redesign the division of labor among laws and agencies. The rules governing issuers, reserves, and redemption obligations should be handled in a separate part of the law, taking guidance from the GENIUS Act, the European framework, and Hong Kong's model. Meanwhile, conduct rules and user protection obligations for exchanges, custodians, and intermediaries should reside in the Virtual Asset User Protection Act. Institutions such as the Financial Services Commission, the Financial Supervisory Service, the Bank of Korea, the Ministry of Economy and Finance, and the Ministry of Science and ICT must be realigned by function using a Federal Enterprise Architecture, FEA, Federal Enterprise Architecture of the U.S. federal government perspective. Only through such clarification will regulations become intelligible and market participants understand clearly which laws they must follow. Third, we need an integrated macro-level design. Before anything else, Korea must articulate a big-picture vision answering basic questions. Who will be allowed to issue won-denominated stablecoins and under what conditions? To what extent will dollar stablecoins be allowed to circulate domestically? How will the Bank of Korea's Digital Won CBDC, central bank digital currency, and private stablecoins divide roles? In that framework, the Capital Markets Act should take responsibility for security tokens and investment contracts, while stablecoins are incorporated as a new pillar that connects monetary policy and financial stability. Where necessary, this will require harmonizing with the Foreign Exchange Transactions Act, deposit protection arrangements, and bank capital regulations in an integrated design. In conclusion, the GENIUS Act is a law that rearranges the relationships among the United States and the dollar, banks and treasuries, big tech and crypto, and major powers and emerging economies within a single digital payment network. What Korea and its citizens must do is decide for themselves what position and role to choose on this massive game board. Whether we remain passive end users of a digital dollar regime designed by others, dragged along by ignorance, incompetence, and greed, or whether we study global standards and world best practices and use a Korean version of FEA and relational philosophy to design a new digital finance order of our own, is a choice that must be made now. Thank you for watching Professor Nam Yong Lee's long commentary.